Alex Morgan here, and before we get into today's video, I want you to pause for just 1 second and really think about this. When was the last time you felt truly confident about where your money was headed? Because right now, as we sit here on the 27th of February 2026, Wall Street, the beating financial heart of New York City, the nerve center of global capitalism, is shaking. Not collapsing, not crashing, but genuinely, visibly trembling. And if you're an investor, a trader, or just someone who cares about the direction of the economy, you absolutely need to understand what is happening right now, why it is happening, and most critically, where things are likely to go from here. So stay with me because this video is packed with fresh, real market data, and by the end of it, I am also going to show you something that most mainstream financial commentators are completely overlooking: the silver metal market, and why what is happening on Wall Street is directly connected to one of the most explosive commodity setups we have seen in modern financial history. Let us start with what is actually happening on the floor of the New York Stock Exchange right now. The numbers are not lying. The S&P 500 shed 1.04% and closed at 6,837.75, pushing it back into negative territory for the year 2026. Think about that. We are almost 2 months into the new year, and the benchmark index that everyone looks at as the pulse of the American economy is already underwater for 2026. The Dow Jones Industrial Average has also been bleeding. The Dow tumbled more than 800 points in a single session, while the S&P 500 and Nasdaq Composite each dropped more than 1%. These are not tiny statistical blips. These are real, painful losses hitting retirement accounts, ETFs, and portfolios belonging to everyday Americans. Now, the question everybody is asking: what on earth is going on? And the answer is not a single thing. It is a perfect storm, a collision of forces all hitting at the same time, and New York's financial district is right at the center of it all. The first and most dominant force is something that I would call the Great AI Reckoning. For the last 2 years, artificial intelligence has been the religion of Wall Street. Tech companies promised infinite growth, trillion-dollar valuations, and a new industrial revolution. Investors poured money in without blinking. But in 2026, reality is starting to bite back hard. Software stocks such as Microsoft and CrowdStrike came under renewed pressure as AI disruption worries hovered over the market. Microsoft dropped 3%, while CrowdStrike retreated nearly 10%. And it gets deeper. Stocks linked to trucking and logistics, commercial real estate, and financial services have suffered losses this month as well. Concerns around what AI could mean for the economy were fueled after Citi Research published a piece suggesting the AI boom could drive unemployment to 10%. 10% unemployment. Let that sink in. Wall Street's own research arms are now publishing research papers that suggest the technology they spent years pumping could hollow out the very economy that sustains their profits. The irony is almost too painful to watch. And then there is the Magnificent Seven. Those 7 tech titans that basically carried the entire market on their backs for 2 straight years. All but 2 of the Magnificent Seven stocks are in the red to start 2026, with Microsoft down nearly 18% and Tesla and Amazon each shedding more than 8%. The declines come amid concerns about these companies' soaring capital expenditure on artificial intelligence and their ability to meet increasingly high earnings growth expectations. These are not small-cap speculative bets. These are the most valuable companies in the world, and they are bleeding in front of our eyes. When the giants stumble, everything else feels it. Now let us talk about Nvidia, because it is the single most watched stock on the planet right now, and what happened this week deserves a very close look. Nvidia is up just 1% in a month and 2% year-to-date in 2026. For a company that was supposed to be the undisputed king of the AI era, those are shockingly underwhelming numbers. The company reported strong earnings, another beat on both the top and bottom lines, but the market shrugged. Nvidia shares actually fell about 5% after reporting, as investors began asking the question that no one wanted to ask 12 months ago. What happens when AI capital expenditure peaks? Other chip stocks, including Broadcom, Lam Research, and Applied Materials, all fell more than 5% on fears about the sustainability of AI spending. When even the chip sector, the hardware backbone of the AI revolution, starts cracking, it sends a very clear signal to the entire market. The second massive force shaking New York right now is the tariff chaos coming directly from Washington. Wall Street kept relatively calm after the Supreme Court struck down President Trump's sweeping tariffs, which had triggered panic in financial markets when first announced. The S&P 500 rose 0.7% on the day of the ruling, though it had been flipping between small gains and losses before the decision, following reports showing slowing economic growth and faster inflation. So the Supreme Court struck down the tariffs, which sounds like good news. But here is the twist. President Trump responded on Truth Social, warning that any country wanting to play games with the court's decision would be met with much higher tariffs and worse consequences. And then he moved swiftly, announcing a 15% global tariff rate, up from the previous 10% level. Markets did not like any of this uncertainty one bit. The third force, and this one is deeply structural, is the Federal Reserve. The Fed cut interest rates 3 times toward the end of 2025, partly to help counter a weakening jobs market. But inflation remains above the target rate of 2%, and cutting rates further risks adding more fuel to rising prices. This is the classic impossible trap. If the Fed cuts rates to save the economy, inflation stays sticky and erodes purchasing power. If it holds rates high to fight inflation, growth stalls and the stock market corrects. Fed Chairman Jerome Powell himself warned that by many measures, equity prices are fairly highly valued. When the chairman of the Federal Reserve publicly signals that stocks might be overpriced, that is not a small thing. That is a direct warning to every portfolio manager in New York. The S&P 500 has returned an average of just 7% during the 12-month period following a forward price-to-earnings multiple above 22, versus the 10% average return seen across all periods. More concerning, the index has historically declined by an average of 6% during the 2-year period following a forward PE above 22, compared to an average gain of 21% over every 2-year period. Right now, we are trading well above that 22 multiple threshold. The historical data is not a guarantee, but it is a warning light flashing yellow on the dashboard. What is happening in the sectors that used to feel safe? Even those are rotating in strange ways. CBRE, the global real estate giant, tumbled 13.5% in a single session, a drop that analysts pointed out was more severe than anything seen outside of the COVID crash and the global financial crisis. That sell-off reflects a sharp rotation out of companies most exposed to AI disruption, first in software, then in financial firms, toward more defensive sectors such as consumer staples. Financial stocks, including American Express and MasterCard, also pulled back on fears that AI could eventually disrupt traditional wealth management and payment processing businesses. This is a market searching for safety in a world where the definition of safe is changing by the week. So where does all of this leave us? And more importantly, where does it leave your money? Let us now look at what could happen next, because this is where it gets truly fascinating, and this is where we have to talk about silver. Wall Street analysts have a median year-end target of 7,650 for the S&P 500, implying nearly 12% upside from where the index started the year at 6,845. That would crush the 20-year and 30-year averages. But here is the critical caveat that most commentators gloss over. The median Wall Street estimate missed by 5% in 2025 and by a staggering 25% in 2024. Wall Street's forecasters have a dismal track record, and their bullish consensus right now does not mean it is going to happen. What the smart money appears to be doing is rotating, and where it is rotating toward is extremely telling. Utilities, consumer staples, hard assets, and most powerfully of all, precious metals. Which brings us to silver. JP Morgan Global Research sees silver prices averaging $81 per ounce in 2026, more than double its average in 2025. Silver prices rose by more than 130% over the course of 2025, fueled by industrial demand and uncertainty over tariff regulations. But this is not just about investment demand. Silver is no longer just a monetary metal sitting in a vault. It is transformed into something far more strategically important. Heavy demand for silver through 2030 is coming from the cleantech sector, mainly from the solar and electric vehicle segments, and from emerging technologies such as artificial intelligence and data centers. Silver's critical role in these economically important industries led the U.S. government to include silver on its list of critical minerals. Think about that for a moment. The very AI spending boom that is currently terrifying Wall Street tech investors is simultaneously creating an insatiable industrial demand for silver. Every data center needs silver-based conductors. Every solar panel contains silver paste. Every electric vehicle carries silver components. The metal that Wall Street ignored for decades has quietly become the backbone of the technologies that Wall Street is obsessed with. And the supply picture is alarming. Metal Focus forecasts a 5th straight year of a silver supply deficit for 2025, coming in at 63.4 million ounces. While that deficit is expected to narrow to 30.5 million ounces in 2026, the firm is confident that the shortfall will continue to be a structural factor. Silver inventories at the Shanghai Futures Exchange have plunged to 715 tons, the lowest level since July 2016, marking an 86% collapse from the 2020 pandemic peak. When inventories collapse like that in the world's largest commodity trading centers, prices do not stay quiet for long. The institutional price targets are extraordinary and worth repeating. Goldman Sachs expects silver to average between $85 and $100 per ounce in 2026, viewing it as the primary strategic metal of the green transition. Citi has issued a target of $110 for the second half of 2026, citing an acute shortage of physical silver available for immediate industrial delivery. For 2026, the average forecast spans a wide range, from $49.25 on the conservative end from TD Securities to an aggressive high of $309 from Bank of America's most bullish scenario, with Citigroup projecting around $70 and HSBC projecting a range of $58 to $88. Now, which direction is silver most likely to move from here? Based on the convergence of data we have walked through today, the answer points strongly upward, but not in a straight line. After political instability around the Federal Reserve and weakening economic indicators, the market now expects multiple rate cuts through 2026. Lower real interest rates are historically bullish for precious metals, especially silver, which benefits from both safe haven and growth-sensitive demand. If the Fed pivots more aggressively dovish, particularly after Chair Powell's term expires in May and a potentially more accommodative successor takes the seat, silver could accelerate sharply. The selection of a more dovish Fed chair could accelerate the debasement trade, while a hawkish appointment could temporarily cool the rally by keeping real yields elevated. The technical picture backs the fundamental case. Having broken above a 13-year resistance zone near $50 to $54, silver faces no meaningful technical overhead until the $72 to $88 range. That is a wide-open lane for price discovery. And silver already advanced to open the 2026 trading year, with precious metals building on their best annual performances since 1979. The risks are real, though, and you need to know them. A sharp global manufacturing slowdown triggered by aggressive U.S. tariffs could soften industrial demand and pull silver lower temporarily. A surprise, hawkish Fed decision, if inflation data comes in hotter than expected today on the PPI print, could spike real yields and pressure silver in the short term. And if Wall Street's tech sell-off accelerates into a full-scale risk-off panic, even safe haven assets can see short-term selling as traders raise cash across the board. But here is the big picture takeaway that you need to carry with you after watching this video. Wall Street is not collapsing. New York's financial hub is shaking because it is repricing. The era of unlimited AI euphoria is giving way to a harder question. Which companies actually deliver real profits from artificial intelligence, and which ones are burning capital chasing a dream? That repricing creates volatility, and volatility creates opportunity. The smart money is already moving, out of overvalued software names, out of speculative AI plays, and into things that are real, scarce, and industrially essential. Silver sits right at the intersection of all of those qualities. This is Alex Morgan. The data is clear, the direction is visible, and the next move belongs to those who understand it first. If this video gave you value today, drop a comment below telling me your silver price target for the end of 2026. I read every single one. Subscribe so you do not miss what is coming next, because the market is moving fast, and in this environment, staying informed is not just smart investing, it is survival.